All right, good morning. My name is Monique. I am the Membership and Events Director for the SVO. Thanks so much for being here with us this morning. I would like to introduce Catherine Satcher, our Chief Operations Officer, to tell you about SVO and what we've been up to. Hey, Kath.
Hey, good morning, everybody. It's great to see everybody. This helps feel a little bit like we're semi back to normal. So we're so happy for you guys to join us today for this webinar. We're really excited to partner once again with our SVO member, PP&Co. And just in a few minutes, we're going to hear from their senior partner, Tom Wagstaff. So first of all, I wanted to take care of a couple of housekeeping items. I'm sure you all have been on 100 of these Zoom calls by now, so you know the drill. But just a reminder that all attendees are muted. So if you have a question that you'd like to ask Tom throughout his presentation, please go ahead and write it in the chat box. And he's going to do his best to try to answer them throughout the presentation or at the end. Before we get into our webinar, I really want to just take a moment and thank you guys for your membership and your support. Throughout this really strange COVID era, the SVO has been able to continue its operations and to be there for your business. And it's really only because you guys have continued to support us. So thank you for that. We really appreciate it. We're working really hard behind the scenes to try and get your business back open. And we are also focused on continually posting new information as we get it and compiling all of that onto our COVID-19 business resource page. So if you haven't been to our website, there'll be a little red bar that pops up as soon as you get there, and that's where all of our information is housed. So more importantly, we want to make sure that we know how we can help you. If you have any questions or ideas about future webinars or issues that you need help understanding, such as this topic today, please let us know, because that's really what we're here for, is to make sure that we can kind of provide you with information and connections. So speaking of that, now we're going to jump into our webinar. It really seemed like the information and regulations surrounding PPP was consistently changing, as is everything with coronavirus. You learn one thing and then something else changes and then something else changes. So we are really excited to have Tom here to help break it all down and particularly talk about the release of the Paycheck, all of these are tongue twisters, Paycheck Protection Loan Forgiveness application. So with all of that said, thank you for being here, Tom. Welcome back, and we'll hand it over to you.
Thank you very much. Welcome back, everyone that was here the last time. These presentations, as it was just mentioned, are a little tricky because every time I schedule one of these, it's like the SBA somehow finds out about it and changes the rules. So my outlines are a continuing changing thing. You can imagine how tricky it gets. I always feel like I'm presenting fake news if I don't, I hate that term, if I don't keep updating it. So I was in the last couple of days going through our outline that I thought was fine when the application forms came out and realizing that now everything has changed again. So the presentation we're giving, the outline was originally orchestrated when the application forms came out that were helping give us some of that needed guidance we needed for the how the forgiveness part of this worked. And then, of course, on June 1st, they kind of laid a good bomb on us, but a bomb, which is to say they changed everything. So this is basically this saying what is obvious, that this is a rapidly changing scenario. The term that the SBA uses is the big giveaway as to how bizarre the whole thing is, because they keep presenting us with what they call interim final guidance. And my vocabulary, I thought interim meant not final and final meant not interim, but they call them interim final, which means it's final until they change it. And they change it just when you're ready to go with what you think you understand. So the presentation is going to be in the form of the general overview, then the issues about maximizing the forgiveness, the further reductions in that forgiveness computation, and the documentation you're going to need. When I was originally preparing this, I was actually going to put the couple of the forms of the application on the screen. Thought that might be too accountantish, and thank goodness we didn't, because the forms that they issued on May 15th are now invalid. They're going to have to change them all with the changes. And I'm going to outline the most recent changes from June 1st as we go through the presentation. But let's just do a little background for people that weren't at the last presentation or just need to get us kind of our bearings and where we're at. March 27th, the CARES Act, a very rushed and huge package presented by Congress and passed on March 27th, $2.3 trillion relief package overall. Of that 2.3 in the original package, about 350 billion was to go to small businesses in the form of these PPP loans that we're about to discuss now in terms of the forgiveness phase. We knew, and that's where we gave that last presentation, that had happened. And we were now trying to educate people on how to get the loan. It was a first come, first served scenario. So people were anxious to get them. It really isn't a loan in the sense that if you follow the guidelines, you could get it forgiven. That was the big hook. So we really, in kind of warp speed, tried to go through the guidelines. It was clear that the guidelines were written in a rushed way. There were inconsistencies. There were outright contradictions in the rules between what the SBA said and what the original CARES Act said in Congress. It was pretty much a mishmash. And yet our guidance was move forward, get your relationship with the bank going, and we'll fill in the details later. And it was an interesting period that week after the PPP, the CARES Act was released, and they gave banks only a certain amount of time to basically start executing these loans, even though the banks didn't actually fully understand what exactly they had, rules they had to abide by, what were the definitions of key terms like payroll costs, how did you work it for self-employed people, which is full of holes. And so really on the eve of the actual loan period starting, with everybody getting ready and all the anxiousness, a couple of the major banks said, we're just not going to do it. We're just not going to do it until we understand our exposure. They had this dramatic meeting the night before. That was a Thursday night with Mnuchin, the Secretary of Treasury, and a lot of the major bank CEOs, and they came up with some resolution that allowed them to just go ahead with it. There was some kind of assurances given to the bank, maybe in the form of we'll purchase these loans or something, but we need to get the ball rolling. This was meant as a fallback position for businesses that were in desperate need of failure. I've never given presentations like this that are so urgent in terms of the people listening. Their businesses are on a cliff. And this loan was potentially the respiration they needed to survive it. And yet, so we were rushing through that process. Then, as you probably recall, what happened, and this happened after our last meeting, is that there was a stampede for the loans. First come, first serve. Within very short order, 350 billion of that first tranche was absorbed. And then we found out that much of those loans went to recipients that weren't necessarily the people and small businesses that were being targeted. Some large companies like Ruth Chris, I mean, these are they deserve attention too, but they were swallowing up a lot of the loans. A lot of negative publicity with the whole program. The original concept of who qualified for the loan was people who had economic uncertainty about their future because of the virus. Let's face it, what happened to us was not about an economic downturn. This isn't like the prior economic crises where there was something wrong with our economy. This was a self-induced coma. Businesses didn't want to close, they were forced to close. So this was meant as a lifeline to those businesses to keep them to survive during this period. And those funds got absorbed quickly, so there was a quick movement to increase the package, do a second tranche. They did essentially another 300 some odd billion dollars to get to a total of over 600 billion in this process. One of the reasons it's been such a difficult process is not only are they rushed, but the SBA has been assigned the responsibility for administering this along with the banks. And the SBA typically does about 30 to 50,000 loans a year. There's 3,300 employees at the SBA. Now, with this the advent of this program, suddenly there are 30 million small businesses that could potentially qualify for this loan. That was the crux of the problem, is trying to process all that, get all the guidelines out. It was almost an impossible task. And actually, in the end, over 2 million small businesses have already gotten these PPP loans. 2 million have already received the loans. My understanding is there's about 550 billion, give or take, left in the program to be dispersed. So there's some funds left. But now, as I said earlier, the PPP loan is only a loan in name only, because once the borrower receives the funds, the amount spent during what we call the covered period, and that's a key term, covered period, that is spent on the payroll, mortgage interest, rent, utilities, is eligible for forgiveness. That covered period until about 4 days ago was 8 weeks. That 8-week period caused trauma to the people who got the loans. So what happened is, it reminds me of, it reminded me of, like, I'm older, but if you remember the movie The Candidate, where the whole movie's about the excitement of this political campaign. It was Robert Redford. And at the end of the campaign, the end of the movie, he wins. And there's excitement and he wins. And the last scene of the movie is he's getting in an elevator and he's looking at his campaign head advisor, and as the elevator door is shutting, he says, "What now?" And the door shuts and it kind of leaves it open. Well, that's kind of what happened to the people that got the loans. So my clients were calling me when they got the loan saying, "Thanks for your assistance getting the loan. I'm really excited." And that was a Friday. And like the next Monday or Tuesday, they called me and they said, "What next? What do I do now? I'm a little worried. We're still under the COVID. We're being told we're SIP, shelter in place. My business isn't open. How does this forgiveness process work?" You gave me the broad outline. Well, we told him then he had 8 weeks to spend those funds, and 75% of those funds had to be spent on payroll. The idea, the concept of the process originally, I believe, was that 8 weeks would pretty much cover it and we'd be back going within 8 weeks. Well, we now know that did not happen. So we're still now more towards the 3/4 mark in the 8-week period. And a lot of companies have not opened, particularly restaurants. So there was a huge lobbying effort, particularly by the Restaurant Association, to get these terms reduced, or in the terms of the payroll percentage, or extended in terms of the covered period. And this week, that covered period, which was 8 weeks, this is the most significant thing to know, was extended to 24 weeks. Gives you a lot of breathing room to meet the rules that I'm about to disclose in terms of the forgiveness. Because they rushed this out, there's still open questions again, but 24 weeks is the new covered period to meet the payroll, mortgage interest, rent, and utility expenditures. By the way, those expenditures should sound familiar. Those were the same expenditures we used to justify the loan to begin with. It is a payroll protection loan. They mean it. So the primary purpose of the loan was to spend it, to retain your payroll. And that was created by this 75% test. And 75% of the funds should be used for payroll in the 8-week covered period. The other major issue was the 75%. Well, if you're closed, you're not going to meet the 75%. And there was an initial concern with the way the law was written that if you didn't hit 75%, none of the loan would be forgiven. We had a heart attack about that, but we did get interim guidance that ultimately explained that you could get partial forgiveness even if you didn't hit the 75%. But as we remain closed, we know that the 75% is a pipe dream. So they changed it in this most recent adjustment to the law to 60% for payroll. Health insurance and pension contribution increased. The non-payroll portion was 25, is now 40. So 60% is the new key number. 24 weeks covered period, 60% is now the new payroll percentage. Your banker is your gatekeeper. The bank will be the one who helps determine the amount of the forgiveness along with following the SBA guidance. I should note at this point, when we got the application forms on May 15th, it did give us some explanation of how this process worked, albeit using these old percentages. There's a line on the first page of that document on the forgiveness, and it's in the middle, and it says, is this loan or is not this loan not under $2 million? It's the most important box in the entire application form. If it's under $2 million, you need to make that clear, because if it's when the big hullabaloo came because of the problem with who got the loans, the Mnuchin and the people in the SBA kind of changed the game rules right when we were in the middle of the process, which is to say, as I said earlier, the purpose of the loan was supposed to be if you had economic uncertainty. And so they felt that companies like Ruth Chris did not have economic uncertainty and may not have deserved the loan, and maybe they did. But so they changed the definition to now, did you have an economic need that you could definitively show? That's a whole different level. And they gave the recipients of the loan a little period of time to pay it back, and some did. But the other provision in that guidance was that loans of $2 million and under were going to clearly get less review from the SBA. $2 million and above, the term audit was the term you got kicked around, but clearly they're going to look at it much more carefully than the under $2 million. And I think it's safe to say if it's under $2 million, given the guidance and given the whole intent of this process, which was to get the money out to help companies in this self-induced coma, that there probably are going to be pretty flexible in how you meet the guidelines and how you present your forgiveness application. But you have to hit that box to indicate that it's under $2 million. Okay, the forgiveness is based, this is the rules for the forgiveness. We went through these in the last presentation, but now we've got some more body to the rules, and we have the application form delineating how you're presenting it, albeit using outdated periods. I think we can still look at that form and see how they're going to make some tweaks to it for these different periods and percentages and still use the basic presentation of the form. So I'm going to be referring to that form as we go through this, because I know a lot of you are looking at that form now and being stumped by how to present your data to get the forgiveness. The forgiveness is based on the amount spent on eligible payroll and other expenses in the 24-week period, not 8, or the alternative covered period, which they added in an interim guidance. That was previously an 8-week covered period. You may opt, this is important, you may opt to keep the 8-week period. I've had clients immediately when this happened call me and say, well, great, I've been strictly abiding by the rules for the 8-week and meeting the 75% test, but it's not going well. I don't know if we're going to survive, and now am I potentially losing the opportunity to get this forgiven? Answer, no. The 8-week period is the one you can retain if you want. But the 24-week period begins on the date of the funding of the loan, and that's the other important thing to know. That covered period, it doesn't start when the loan was executed. It starts when the loan is funded. The clock starts ticking. It's a 24-week clock, not an 8-week clock. I mentioned the alternative covered period. That's the 24-week period beginning with the first payroll starting after the funding date. This is a little indication of how flexible they are in the presentation. Why? That way, a lot of clients, my clients were like, well, this is going to be tricky. Our payroll staggers in and outside that 8-week period. The alternative covered period allows you to basically start the period with your first payroll rather than the date the loan was funded, and then you follow through on that alternative now 24-week period. Important, probably the most often asked question after we got through getting the loan is, what were the eligible expenditures definition? And the definition was paid and incurred in the period. Paid and incurred in the period. Depending upon your level of aggressiveness or being conservative, you can interpret that in a number of ways. So we were wondering, does it have to be paid and incurred? Bad. Does it have to be paid and you also get to add costs that were incurred? Can you accrue costs that had already been accrued and were paid but were not incurred? You can see all the different permutations. This was significantly relaxed by the interim guidance on May 22nd. This is important. They gave an extremely broad definition of what is paid and incurred to meet the tests for the 24-week period. Costs paid or incurred within the covered period eligible for forgiveness. Special rules governing paid or incurred for payroll costs. Paid is date distributed, so you could immediately pay wages that had been earned prior to the covered period. They hadn't been accrued or incurred in the covered period, which was one of our concerns, but it was paid in the covered period. They count. Incurred after added flexibility in guidelines. The payroll costs incurred for your last pay period of the 24-week period are eligible for forgiveness as long as they're paid no later than the next regular payroll date. That's where a lot of our questions came in. They gave a lot of specifics to this. Payroll is incurred and paid on the next payroll date. So it doesn't, in that regard, have to be paid during the covered period as long as it was incurred during the covered period and paid no later than the next regular payroll date. So as you can see, it's a very expansive definition of paid or incurred. For non-payroll costs, expenses must be either paid during the covered period, either, not both, either paid during the covered period or incurred during the covered period and paid by the next regular due date, even if that due date is outside the covered period, the next regular due date. This is the prepaid rent question or the accrued rent question. People are having trouble potentially, although not often, hitting that previously 25, now 40% limitation for the non-payroll costs. Expenses that were accrued prior to the period and paid during the period count. And if you have rent, for instance, accrued during the period and paid in the next due date, those will also count. What we don't know, because if you're like my clients, they immediately want to take advantage of once they see these rules that are creative. So you're saying, if a lot of my clients start their questions with, so you're saying that if I have an accrued expense, I can pay it during the period and have it count. How far back can I go? We know you can only go forward to the next regular due date. How far back? We don't know. They didn't specify that to my knowledge. I think you've got to be judicious about this and don't, I mean, they've been very liberal with the interpretation of this. Let's not make a mockery of it. So I'm telling my clients, just within the most recent pay periods, you can prepay. You can pay the accrued. So that's a very positive development in terms of what counts in the covered period as a eligible cost for forgiveness. Okay, to maximize the forgiveness, eligible expenditures consist of what we call the 60% expenditures, which are those payroll costs. They're originally the 75%. What is the payroll? It's very similar to the definition. It is the definition we use to get the loan. It's limited by the amount of $100K per person annualized, $8,333 a month. There's another limitation that's subtle. There's a limitation for owners. Yes, their limitation is that same amount. But the way it's presented in the application form, we'll see they isolate the payments to owners from a different section. And I think a lot of us think that is because insurance, the other payroll kind of costs related to compensation, insurance, we don't think is going to count for owner employees. And that's why they broke that out. Get this off. Okay. The other category, state employer taxes, that's a small number. That's your SUI in California. It's not a big number. Pension contribution and health insurance. Pension contribution paid during the covered period. I already just described that they gave a very expansive definition of what is paid and incurred in the covered period. And it was pretty clear. It's for payments for the next pay period that they've been incurred. It's kind of within that umbrella, but pensions are different. Pensions are numbers that are a little more hypothetical in terms of how much you're going to contribute. What is the definition? What is a qualified pension contribution within that period? If you look it up, you're going to find most experts kind of throw their hands up and say, I need further guidance, and it is true. But I think my read on it is the ones that are safest are the payments that are made within the period. And I feel pretty confident saying if a employer, these are the employer pension contributions, by the way, but if an employer made a payment during that period, I think those are going to count. The question is, how about payments that are basically for an entire period that includes that period? Do you have to prorate it? Can you count it? That's a little more subjective, but I have to say we do need guidance on that. And as I said, this is the employer's pension contribution. The employee's deferred pension contribution, that's not this. That's already been included in the gross payroll number. So this is about the employer's contribution. Health insurance. So you're going to need to keep track of the health insurance you pay for the employees during the covered period. And I think we're going to have to isolate the health insurance for the employees versus the owners because of the way the forms are being presented. The 40% expenditures, originally the 25%, rent, mortgage interest, utilities, internet, telephone, gas, transportation, vehicles. Transportation, we think probably just means gas. I don't think it means repairs, but there may be some clarification on that. But some people have been asking for that question. I think a car lease payment would be eligible under the definition of rent or mortgage interest, because those are all about payments that are made on contracts, business payments that are made for business obligations that were in establishment before February 15th of 2020. So if you have a mortgage before February 15th, it started before February 15th. I think if you have a car lease that started before February 15th, I think those definitions all count in terms of what would qualify for a 40% expenditure. Utilities is this broad term, but they were pretty specific on what utilities, which was, I think I wrote it down here somewhere. If not, I'll go through it later. It's phone, gas, internet. They added internet, water, electricity. Garbage, don't think so. Okay, shouldn't use the word garbage in a presentation, but I just did. So the reduction in the loan forgiveness is the most complicated element of this process, and it's the one that got some clarification in the loan application form that unfortunately we can no longer use because it has old, outdated percentages. But I think if we refer to it, I think conceptually you're going to understand how this works. By the way, the loan application form that you must, the forgiveness application form, I should say, that you're submitting, and is supposed to be submitted at the end of this loan period, which has been extended. So that form has 10 or 11 total pages. Most of it is narrative and instructions. There are only 3 pages that actually have data on them, 3 pages. The first page is the most important one. It's the one where you crunch the numbers that say, what is my loan forgiveness? But that page pulls from the prior page, page behind it, which is called a Schedule A. That Schedule A is outlining all your payroll costs. That Schedule A gets the eligible payroll costs from the most complicated form, which is the attachment to Schedule A. That's the third form, and that is the form that you use to compute the salary reduction and the FTE, full-time employee reduction. This is the part that is confusing. This is the part you may need help on. This is the part I think templates are being developed to help you. I'm sure payroll services are doing it. That's what I'm understanding. We're going to post on our resource center page some templates as we find out about them to help you, and we can help you do it as well. Even in our firm, we're developing within our group some capacity to help our clients do it internally, because it is pretty thorny calculation. There are two elements of reduction: salary reduction and FTE reduction, full-time employee reduction. Conceptually, what they're saying is the loan is going to be forgiven. You got the loan based on what you said your payroll was going to be using prior year's numbers, but what you felt the payroll was going to be. Now we're in the covered period. Now we're talking about reality, what they actually were. If the actual salaries paid were significantly less, i.e. more than 25% less than the original amount, then you're going to have a reduction in your loan forgiveness. To do the calculation, you're going to have to know the covered period, which we know, that's the average annual salary for each employee for the 24-week period starting when the loan is funded. The loan funding starts the clock on the 24 weeks of the covered period. The key word is average, and that's why I think what I'm saying from the application forms is still applicable even if they change the period from 8 to 24. Average salary for each employee during the 24-week period. That's the covered period. You're going to compare the covered period to the reference period. Covered period to reference period to determine whether or not you've had a reduction. For the salary reduction, the reference period is specific. It's January 1st, 2020 to March 30th, 2020. So when you're providing your documentation, when you apply for the loan forgiveness, that's one of the things you're going to have to provide is your payroll information from that time period. You're going to compare the covered period to that reference period. This is on table 1 of the 3rd page of the application form. And you're going to compute this reduction if, in fact, the salaries went down. I'll give you an example. You have an employee that during the reference period was paid $80,000 a year. That was his normal salary. That's your reference period amount. What they're trying to figure out is whether or not during the covered period, even though you retained him, you paid him a lot less. So say that person during the recovery period that they paid him less, that it was $52,000 a year. So 75% of the amount in the reference period, the amount that you're supposed to hit is 60,000, 75% of the 80. So you were supposed to pay 60. You paid 52 in this scenario. You're 8 short. That 8, you're more than 25% short. You're only at 65% for that employee. You've got to do this calculation if you meet that scenario. And the calculation is kind of, if you annualize these numbers, to come up with the amount that you underpaid that employee on an annualized basis. And it doesn't frequently come up to that large a number unless that person was significantly underpaid. The full-time employee reduction, first of all, we didn't know the definition of a full-time employee when they wrote the original guidelines. They have since given us the definition. I'm going to give that to you in a moment. But for now, let's just assume that it's a full-time employee. For that, again, you have to compare your covered period to a reference period. The covered period is your average full-time employees during the 24-week covered period. This is where you're going to have to go through and analyze each employee to figure out what that covered period status was. The reference period for the FTE, for the employee reduction computation, you get to choose a reference period. And you make a choice based on whether or not you had a significant reduction earlier in the year on your payroll. That would make it easier to match and meet the test for the retention of your employees. So you use either February 15th, 2019 to 6/30/2019, the old reference period, or you can use a more recent reference period, January 1st, 2020 to February 29th, 2020. You choose a more beneficial one and you do the analysis of whether or not your full-time employee count during the period covered was significantly reduced from the amount in the reference period. There's a safe harbor. There are a lot of safe harbors throughout this whole process. You can see the spirit of this is to try to get you to not have to forgive, frankly. That's why they keep throwing in the safe harbors. This is maybe the most important safe harbor, which is say your employee count did go down, which is likely in this scenario. You could restore your employees and not have to do the employee reduction if you restore that employee base to your February 15th, 2020 level by December 31st, 2020. If you hadn't read any of the new guidelines, you were panicked because you thought it was June 30th is when you had to restore all your employees. And that wasn't happening. But now they've given you to December 31st to get back to your February 15th, 2020 date. For reasons that I mean, they just chose a date. In the SBA's world, the pandemic started on February 15th, 2020, just so you know. I didn't know that, but apparently they knew that. That's the date they're using. You have to restore, you can restore your employee level to that and not have to do the FTE, the employee reduction analysis, or the salary reduction. That safe harbor applies to both. So you've got some potential relief there. There's more relief coming in terms of safe harbors if you have a problem with these first two reduction areas as well, and I'll go through those. Okay, one of the new safe harbors is employees, an exemption for having to do the forgiveness reduction for employees who refuse to come back to work. You shouldn't be punished if you tried to have somebody come back, but your full-time equivalent employees went down because they wouldn't come back. So here are the rules to exclude that type of client employee from the analysis. If the borrower made a good faith effort, written offer to rehire such employee during the covered periods, you're going to have to keep your offers and present it to the SBA at the time of the loan forgiveness declaration. The offer was made for the same salary and same number of hours as earned by such employee in the last pay period prior to separation. The offer was rejected by the employee in writing. So if your employee says, I'm not coming back, it's going to be a little awkward. You're going to say, well, that's okay. Could you just put that in writing for me? Because we don't want to have part of our forgiveness reduced because of you. The borrower maintains records of the offer and its rejection. That's what we said earlier, because you're probably going to need it for the loan forgiveness application. The borrower, this is a little ill-defined, the borrower informed the applicable state unemployment insurance office of such employee's rejected offer within 30 days of the rejection. So, I mean, I think these are kind of the normal California type requirements to notify the Employment Development Department about this. There's not actually a form right now. In the guidelines, it said we are waiting more definition of what that death proof would be, but you're supposed to come up with some form of notification to your state unemployment insurance office. If you meet those 5 tests, that person who doesn't want, who can't come back to work is not included when you do the full-time employee reduction. This is probably the one part of this whole scenario that is bad, that is really bad, and I'm a little surprised about, and I'm becoming less confident that it's going to change by the day. As we said when the loan was issued, and when we went through this process at that stage, one of the great parts of the PPP program is that the loan is tax-free, the forgiveness of the loan. Typically, when you get loan forgiveness, in another scenario, a credit card debt or something like that, that's considered forgiveness and indebtedness income, and it's income to you, or it's income to the business. But in this case, the forgiveness of the loan is tax-free. That's huge, but we already knew that. We always assumed at the beginning of this process that the actual payments that you made with those loans would be deductible. It is kind of a double dip. You didn't actually use your funds to pay the expenses, but after all, the purpose of the PPP program is to help companies who are in a self-induced coma. They didn't required by an outside source. It wasn't their fault. But the IRS, not the Small Business Administration, now the IRS enters this picture And they adhere to their old rules on debt forgiveness, but also on situations where expenses were paid with tax-exempt income. The IRS issued a recent guideline that expenses allocable to tax-exempt income are not deductible. Therefore, the expenses paid by the borrower to the extent of the forgiveness on the tax-free basis will not be deductible. I'm sensing out there some people gasping, this is bad news. And there was a Senator Grassley, who's one of the more important senators in the Senate in terms of the Finance Committee, and he said he was going to fight this tooth and nail. Well, he must have fought it tooth and not nail, because right now this has not changed. We just got to keep an eye on it. It creates a dilemma. There are a lot, I mean, everything they do creates a dilemma, but remember I said earlier, the covered period is now 24 months. So you're not going to actually know potentially by the end of the year whether your debt has been forgiven. You have some extended time potentially if the loan is just being done now. So what do? It's January of next year and you're still trying to figure out whether your loan is forgiven. How do you do your tax return for last year? We don't know. I would think that what they're going to do is allow you to deduct those payments in that year, since you haven't clearly defined that the loan was forgiven or not. And then in your subsequent tax return, you're going to have to recognize that forgiveness of debt income at that point. But it creates a myriad of problems with QBI deductions and other things that are all based on your income level. You may not know your income level right now because of this IRS guideline. Tricky, keep an eye on it, bad news right now, and we'll just see if there's, I mean, in essence, it reduced the overall benefit of the loan by your tax bracket. So it seems to me that in that sense, even though it's true that it's a double dip of the benefit, the proceeds are tax-free, the payment is deductible, would be pretty aggressive. But in the end, we're trying to help businesses stay alive, and I would have thought they would have recognized that. They didn't. What is an average FTE? We never knew that. We did not know that during the loan period. When we were getting the loan, we thought it would be 30 weeks and above, which is an old litmus test. They came up with a much simpler test. Well, it's pretty simple. You simply divide your weekly hour amount by 40 for the employee. It can't be over 1. So if a person's working 30 hours a week, it's a fractional amount. It's 0.75 of an FTE. And you'll have incremental percentages for all your employees that are not 1. It'll be 1 or a percentage like that to add up to your total FTEs. Now, alternatively, you can skip that math and use 1 for every 40-hour employee and 0.5 for everyone who didn't work 40 hours. So if you work, say, 20 hours of the 40, you'd use 0.5. If you use 15, you'd use 0.5. If you work 30, you'd use 0.5. And you probably want to analyze where on the spectrum your part-time employees are. If they're over half, you'd probably want to use the fractional approach. If they were under half, you'd want to just use the 50% they gave you. So that's how you do that full-time employees. So, as I said, that third part of the loan application schedule is how you do that reduction that I was just talking about. The third part, it has 2 sections. The first section is for the people that were making under $100,000 a year in 2019. That's how they use that metric. That's the table 1. Table 1 is the one where at the far right-hand corner of the table, you have to compute the salary reduction if you don't meet the 75% test that I outlined before. That's the table 1. That's the most complicated part of the loan application form. Table 2 is for the employees that make over $100,000 a year. And for them, you know what and on that table, by the way, you're going to put the cash compensation for the covered period. You're going to put their average FTE amount, and you're going to put the salary reduction amount if there is a salary reduction. All of that goes on that form. For a person that was earning over $100,000 a year, the second part is easy. You're just going to put the average amount, what that averages out to in that box for the compensation. And this leads to a tricky element that we don't quite know the answer to with the change. We knew before, and the guidelines even said it, that a person making $100,000 a year is the cap on what can be forgiven. So you do the math, and $100,000 a year
Hey, Tom,
divided by.
can you advance to the next slide? Sorry about that.
Are you okay?
Yep.
Okay, so we knew even on the form they said that amount maximizes at $15,000. It was like $15,385. That was the maximum amount you could get forgiven for a high-paid employee. $15,384. You could just put that number in the box as forgiven for the high compensated employee. Now, since that was an 8-week period, and now it's 24, do you increase that to a larger number, which comes out to $46,000? And I think the answer is yes, because I think that's the intent of the expanding the 24 weeks, is to make it easier to hit the forgiveness targets. We have to find out for sure, but if it's yes, you can see what's going to happen. You're going to fill these amounts in and get a much larger percentage of your actual loan being spent on payroll than you were before. And that was the intent. So I think that's what they're going to allow you to do. The other question is, since they changed it to 24 weeks, are they going to change the reference period? Remember, I gave you those 2 reference periods before. Are they going to change that in any way? I don't know that they have to, because it's all based on averages, but we'll have to keep an eye on that. But that table 3, that table that form that has the tables, those numbers go to the second page, the Schedule A, which has your payroll numbers. It's just pulling from the tables. The tables is where you do the number crunch. You use those numbers to fill out the payroll form, and then you use the payroll form to fill out how much of my loan can be forgiven on the first page. It's those 3 forms that you're working together. You start backwards and move forwards. So in addition, these are other changes that just came out in this last week that are beneficial for the PPP guidelines. In addition to the extension of the covered period to 24 weeks and increasing the eligible non-payroll cost to 40%, HR 7010 creates the following changes. The maturity date of the non-forgiven PPP loan, say you don't have it forgiven, you don't meet those tests, was extended from 2 years to 5 years. 2 years to 5 years. It appears that 2. It appears that if the borrower failed. So I wrote this. This is an ongoing process. It was a scary part of the changes. So I will say it appeared that if the borrower failed to spend 6% of the loan proceeds on payroll costs, that none of the loan would be forgiven, what we call a cliff. That would have been new. That would have been a problem, because the law, the most recent law, the way they wrote it, is that it shall be 60%, which implied to some people reading it that if it wasn't 60%, none of the loan would be forgiven. A disaster. So immediate pushback on that. They acted fast. The SBA has clarified in the last 2 days, this is a fairly current presentation, the SBA has clarified that partial loan forgiveness will indeed still be available under the new 60% threshold. This is really good news. Specifically, if a borrower uses less than 6% of the loan amount for payroll during that forgiveness covered period, which is 24 weeks now, the borrower will continue to be eligible for partial loan forgiveness. That's critical, and that's new. Additional other changes, the period to restore the FTEs. I covered this earlier, but just to pound it home. The period to restore your full-time employees to the February 15th safe harbor level was extended from June 30th to December 30th. You have until December 30th to get your payroll employee count back to where it was on February 15th. That's relief. 4, the new relief for businesses that remain partially or fully closed. This is really significant too. You can see from this that they're trying to give you every opportunity not to have to reduce the loan forgiveness. The loan forgiveness will not be reduced when the borrower experiences loss of full-time employees if that borrower in good faith is able to document, 1, an inability to rehire individuals who were employed on 2/15/2020. 2, an ability to hire similarly qualified employees for unfilled positions on or before 12/31/2020. Or an inability, and this is the kicker, this is the important one. If the reason your number count is down for employees is because of guidelines that you're heeding to, the inability to return to your February 15th level of activity due to your complying with requirements of government orders, Health and Human Services or the CDC, and also for OSHA, during the period from 3/21/20 to 12/31/20. That's a pretty broad safe harbor as far as I'm concerned to be able to explain why you didn't hit your FTE amount. 5, the borrower may now defer all of your 2020 Social Security tax into 2021 and 2022. This is the employer's share of Social Security tax. May now be deferred even if the borrower received a PPP loan. That was not the case before. So that's very helpful too. And by the way, the deferral is over a 2-year subsequent period, 2021 and 2022. What documentation do you need? Well, we have our own PP loan, and we recommended this to our clients too. It's easier to keep track of, and I think it's going to be easier to display your information to a bank in the SBA. Set up a separate bank account for your PPP funds, the coming and going, and keep it non-commingled so you can literally see the stuff coming in, coming out from the PPP loan. That would be ideal. It's not required, but it would be ideal. 2, you're going to need copies of payments made to back up for each period and keep them on file. So obviously for the rent and the mortgage, you're going to have to keep proof of the payments. You're going to have to attach all of the details referenced in the loan forgiveness application. So what is that? That means you're going to have to provide payroll backup. Your 941 forms, I think, is going to be the best. That's your quarterly payroll reports. You're going to have to provide it for the covered period, that 24-week covered period. You're going to also need to be able to provide it for your reference period. That's the one you choose. Remember, February 15, 2029 through June of 2029, or January 2020 through February 29, 2020. You're going to have to also provide those. You have to provide the payroll, 941 payroll records for your covered period and your reference period. For seasonal employees, you're going to have to use the February 15th through June 30th deadline or boundaries. The last full quarter, so you're going to also need to be able to establish what your February 15th full-time employee count was. You're going to need documentation, canceled checks, payment receipts, other documents verifying payments on the mortgage, covered lease obligations, and covered utility payments. So if you have a car lease, you're going to need to be able to provide that. You're going to need a certification from a representative of the eligible recipient, somebody in your firm, to make such certifications that the documentation presented is true and correct, and the amount for which forgiveness is requested was used to retain employees, make interest payments and covered mortgage obligations, and make payments on a covered return obligation, and any other documentation the SBA requests. I think you can see even in that language that there's flexibility and there's a sense of forgiveness in the forgiveness. They seem to be saying, provide the information, but that term good faith suddenly reappears. When you do this certification, were you in good faith when you requested the loan? It's particularly important when it's $2 million or under. So that's the presentation on the changes. I was handed a lot of questions. I'm not sure how we're doing on time. You can cut me off at any point, but I had some excellent questions that are really pertinent to the stuff that I just went through, and some of it really I think will help you understand it. 1, if an employer maintains full headcount during the original 8-week period and is able to properly use the entire PPP loan during that time, will there be a consequence to a headcount reduction? Well, remember what I said. You can always retain that 8-week model that you were using to begin with. So the answer is You can just use that 8-week model. You're going to be okay. Will an extension of time from 8 weeks to 24 weeks have an impact on the Schedule C sole proprietor? So I really didn't go through in great detail about the sole proprietors because they've been kind of left out from the beginning in terms of how the loan was calculated and now the forgiveness. It's just been kind of an afterthought. But it turned out that in the end, when they gave us the definition of how to do it, it's mechanical. If you're a sole proprietor, if you're a Schedule C person, you have your own business, you're a contractor, and you apply for your own loan, how did you compute the amount of the loan? You didn't have a payroll. The guidelines that came out said it's mechanical. You take your Schedule C net profit from the prior year. This is how you get the loan. Your Schedule C net profit, and you divide it by 12 to get your monthly net profit. And then you multiply it times 2.5, that old 2.5 logarithm, to get the amount of loan you qualify for. The maximum amount was $100,000 of net profit. So we knew that that amount came out to roughly $20,000 as the maximum loan the self-employed person could get, roughly $20,500. How is the forgiveness calculated for a Schedule C or self-employed person? Well, that's mechanical too. They're essentially giving you the payroll portion. They're just going to give it to you as a forgiveness. They're going to say, under the 8-week guides we had before, they just said take 8 50-seconds, 8 of the 52 weeks, multiply it times the loan, and that's the amount you get forgiven. They just gave it to you. Now the question, and that came out to $15,000. And then the rest of that $20,000 loan, you'd have to justify through providing your non-payroll backup, your utilities, your rent, and all those. So you'd only be responsible for providing the non-payroll portion of your loan expenditures. So pretty straightforward, and unfortunately the amounts aren't that large anyway. So question, since they expanded it from 8 weeks to 24 weeks, does this number become $46,000 is the potential that could be forgiven, not the 15? That's how the math works when you use a prorated over a 24-week period, which would mean by definition get forgiven. I think the answer is probably yes, and I think really to cut to the chase, I think it's pretty clear that if you've got the loan and you're self-employed, you're going to qualify for the forgiveness. 3, what is the best practice in allocating payroll to the PPP for nonprofits, especially if they have funding sources that cover certain payroll costs? This is a really tricky and esoteric one. I don't specifically know the answer because I looked into this a little bit. By the way, the only nonprofits that currently qualify are 501c3s and 19s. So clubs have been anxiously trying to get qualified, but my understanding is that they still do not qualify for the loan. I may be wrong on that, but I think that's true. So I think that when you're looking at your payroll costs and you're a nonprofit, if you qualified for the loan as a nonprofit and you showed those payroll costs, I would think you'd use the same concept for your forgiveness too, which is you would include them in your forgiveness calculation because you're using the same concept, and that's what I would do. I would include those payments, understanding that they might subsequently be reimbursed. Again, we are waiting for some guidance on that. Can we get more than one PPP loan? No, only one. You can go to multiple banks to apply for a PPP loan, but you can't have more than one PPP loan. For self-employed, I'm a solo real estate agent with no employees, no rent. How do I split out the 75% of the PPP? Well, I just explained that I think pretty well, which is it's pretty straightforward. They're going to give you that 75% right off the top. They're just going to give you that part from a mathematical, they call it income replacement. And then you're going to have to provide support for the other 25%, which should be pretty easy if they extended this period to 24 weeks. How does this affect unemployment? I would assume that's asked by a person that's a self-employed person, remembering that the unemployment rules were liberalized. The feds added another $600 to somebody's unemployment. So in California, if your unemployment was $500 a week and they added $600 a week, you cannot do a PPP loan if you're on unemployment. So you can't get the benefit of both in that regard. So what those people in that category have to do is they got to analyze the benefit of the PPP loan, which is that maximum of 20,000, versus the unemployment you might receive during the covered period. That's how that works.
Hey, Tom, I hate to cut you off. I know we're on a roll here, but we probably have room for maybe one more quick question, and then we're a little bit over our time.
Okay, this one is, I won't ask this one, when is the baseball season going to start? I think that's the wrong, don't know how that got in. Let's see. Well, somebody asked a question about the payroll cycles again, and I think I covered it, but their questions are really helpful, and it's really important, so I'll just do this really quick. They said, our loan date was 4/17, April 17th. That's the covered period date starts. So we had a payroll period prior to that, and we paid it. It started prior to that, but we paid it on April 22nd. We paid it during the covered period, but it included a period prior to that. Remember, that counts because it was paid during the period. We have a payroll period that was paid on May 7th that also includes a little bit of time prior. That counts. Anything that was paid during the payroll period counts. Then they have a payroll period that runs after the covered period, but includes time in the payroll period, but was paid after. That's that new guideline that says as long as it was paid in the next pay period, that counts even though it wasn't paid during the covered period. So that's the key to all of that. It's very liberal and generous in terms of how you incorporate payments made and payments incurred in the covered period. So how are we doing now?
Perfect. Well, I think we have a ton of questions in the Q&A that we are not going to have enough time to address now. So what I think we're going to do is kind of regroup as a team and see the best way that we can maybe get some of these answers out to the group. But Tom, my brain is exploding, and I'm sure everybody else is too. I am so grateful to have you to kind of break all of this down for us, because almost the nuances within it, I really hope they don't come out with something tomorrow that changes everything because of all the effort that you put in.
If you're looking for a frame of mind, almost all the guidelines, even though they are frustrating in terms of they keep changing the rules, without exception, with the exception of the deductibility issue, they're helpful. They help you, and they give you more time to do the calculation, which is really helpful too.
Yeah, that's great to see that they're recognizing kind of the error of some of the other issues and coming back to help businesses. So I know everybody joined. I see some virtual clapping. So everybody, thank you so much for being a part of it. Thank you, Tom, for really sharing your information. And a big thank you to Sarah Lynn and Ron on the PP&Co team for putting this together. Like we said, you might have seen in the chat, the recording of this and the slides are going to be available on our website on that COVID-19 section that I was talking about earlier. And then we'll regroup as a team to figure out how we can give you the best information from this. So thank you all for tuning in. Please keep watching out for more information, and we can't wait till we can see you in person again. So have a great day. Thank you again.
Thank you, Tom.
Thanks. Masks on.